Global capital flow remains to be an important issue within the field of international finance. Capital flow volatility has increased rapidly over the past decade. This can have widespread economic consequences, such as amplifying economic cycles, increasing financial system vulnerabilities, and aggravating overall macroeconomic instability. Our paper here includes a description of existing volumes and compositions of capital flow to Indonesia during this period, an econometric model constructed to identify the push and pull factors that significantly affect Indonesia's capital flow. We follow this with another model that identifies surge, stop, flight, and retrenchment episodes during the past decade, as well as an evaluation of the policy responses of the monetary authority and the government of Indonesia during these episodes. This is followed by an assessment of the impact of capital flow on the financial sector. So, we'll just get started. From this graph of net capital flow and gross capital inflow and outflow, we see that since 2002, Indonesia has had observed surpluses in its balance of payments, with the exception of the 2005 mini-crisis period caused by foreign concerns over rising global oil prices, the fourth quarter of 2008 in line with the unfolding of the global financial crisis, the third quarter of 2011 in the midst of the European debt crisis. These graphs also show a particularly sharp increase in net capital flow from mid-2009 to mid-2011 after a period of deficits. Note here that net capital flow in Indonesia is generally dominated by gross capital inflow in significantly higher nominal amounts than gross capital outflow. We see fluctuations in net capital flow are similarly reflected in fluctuations in gross capital inflow. So looking into a breakdown of gross capital inflow by sectors, then we see that the main engine for capital inflow to Indonesia is portfolio investments. Since 2004, the amount of portfolio investments flowing into Indonesia increased significantly, with notable exceptions only in 2008 and 2011, which triggered massive withdrawals of foreign capital from the Indonesian stock market and government bonds market. Meanwhile, other investment inflows such as currency and deposits, loans, and trade credit showed somewhat volatile trends throughout the last decade. Foreign direct investments generally increased over the last decade, even during the global financial crisis. Significant increases of foreign direct investment inflow primarily occurred after 2010, following the receding global financial crisis. Despite a significant increase in the amount of FDI coming into Indonesia, the relative restrictiveness of FDI regimes in Indonesia remains a subject that warrants concern. Indonesia is ranked 4th from the bottom in the OECD's FDI Regulatory Restrictiveness Index, meaning that compared to other countries, Indonesia is relatively more closed to FDI. Regardless, gross capital inflow over the past decade has been greatly affected by portfolio investments, with several coincided movements. We can see this more clearly in this graph. So, this breakdown of portfolio investment components over the past decade shows that during this time, portfolio investment inflows were largely driven by debt securities, by transactions of debt securities rather than equity instruments. Transactions of debt securities also occurred more heavily in the public sector than they did in the private sector, with the exception of 2011. Portfolio investments also contributed to significant increases in foreign capital inflows during 2009 to 2010 post-subprime mortgage crisis, and in 2013 to 2014, simultaneous with huge capital flows into other emerging market economies. So, since we've established that volatility in Indonesia's capital flow is predominantly caused by rapid fluctuations of portfolio investment inflow, in the next section of finding determinants of capital flow, we use foreign ownership of government securities and net foreign purchase of Indonesian stocks as measures of Indonesia's capital flow. These two variables capture foreign investor behavior in portfolio investments. Recognizing that the volatility of capital flow may have an impact on the vulnerability of the domestic economy towards crises, we attempted to find factors that influence the movement of capital flow through a reduced form multivariate vector autoregression, or VAR model. Following traditional literature, we classify these determinants into two categories: pull or domestic factors and push or external factors. We use monthly data for all variables involved, ranging from January 2004 to February 2015. Impulse response functions were used to illustrate the effect on the response variables when one of the regressors is subjected to a shock in the form of an increase by 1 standard deviation. And Chomsky's forecast error variance decomposition models were also used to measure the contribution of each type of shock to the forecast error variance. So this is the result we got for net foreign purchase of Indonesian stocks. As you can see, pull factors that significantly affect net foreign purchase of Indonesian stocks include nominal yield of SUN, government securities, the current spread, which equates to nominal yield of SUN minus nominal yield of US T-notes, and 5-year credit default swaps. Whereas push factors include the volatility index and global liquidity. Results from the forecast error variance decomposition models also found that the volatility index has the largest relative contribution to the forecast error variance of net foreign purchase of stocks, while the second largest contributor is global liquidity. Here's the impulse response functions of the relationships of each. So this is the result for foreign ownership of Indonesian government securities. Pull factors that significantly affect it include nominal yield of SUN and the current spread, and push factors include volatility index and global liquidity. Again, volatility index is found to have the largest relative contribution to the forecast error variance of foreign ownership of SUN, while the second largest contributor is global liquidity. Note also that the exchange rate of IDR per USD is not included as significant variables, although it proves to be significant variables for SUN in our calculations, but we didn't include it because exchange rate movement in Indonesia doesn't necessarily relate to capital flow. From here then, we transition to identifying significant waves of capital flow in the form of surge, stop, flight, and retrenchment episodes. We adapted the methodology of Forbes and Warnock. These episodes are characterized as surge episodes, which is a sharp increase in gross capital inflow, stops, a sharp decrease in inflow, flight, a sharp increase in gross capital outflow, and retrenchment is a sharp decrease in gross capital outflow. These are the results for our surge, stop, flight, and retrenchment episodes. The first two, flight and surge episodes, is caused by the mini-crisis period caused by the foreign concerns over Indonesia's fiscal sustainability. The third stop episode occurred during the period leading up to the 2008 GFC. The following surge and retrenchment episodes are possible effects of the Fed's quantitative easing policies and all the mixed policy responses introduced by Indonesia's central bank at the time. In the following slides, we will observe the policy responses of BI and government of Indonesia during three main intervals. 2004 to 2005, which is during the mini-crisis period, which involves increasing global oil prices. 2010 to 2011, which includes the policy responses to the Federal Reserve's quantitative easing policies. And 2013 to present, which looks into the impact of the Fed's tapering off their quantitative easing policies. So the period of 2004 to 2005 experienced large capital outflow, mainly due to foreign investors' concerns over Indonesia's current account and fiscal deficits due to rising global oil prices. Early in 2004, uncertainty was looming due to noisy domestic political campaigns, while at the same time, investors were concerned over tight US monetary policy, China's overheating economy, and higher oil prices in the international market. Throughout 2004, direct investments recorded an outflow due to FDI profit repatriation, while other investment flew out at the end of 2003, marking the end of the debt rescheduling program under the Paris Club for Indonesia. A temporary break from these macroeconomic conditions came during the election of a new president on July 2004. However, concerns over high oil prices lingered, which increased risk to the current account balance. In early 2005, while international oil prices continued to increase, concerns over Indonesia's fiscal sustainability due to its huge oil subsidies, created negative sentiment, especially towards the current account balance. With gross capital outflow in the negative territory, the Indonesian rupiah was under depreciation pressure. On April 2005, the central bank issued a regulation to control banks' foreign exchange transactions in order to give banks some slack so that they can still maintain their prudential principles by lowering banks' net open position from 30% to 20%. In addition, Bank Indonesia also increased maximum insured third-party deposit rates in foreign currency from 0.65% to 2% as an attempt to attract exporters to keep their export revenue in the country. On July 2005, Bank Indonesia issued another regulation to limit rupiah transactions and foreign exchange credits from banks to non-residents. This aims to minimize speculative transactions. In another move to stabilize worsening macroeconomic conditions, the government and BI agreed to supply dollar needs to Pertamina directly out of the country's foreign exchange reserves. Both also agreed to require other state-owned enterprises to place their foreign exchange earnings from exports into local banks. The central bank launched another rupiah stabilization package in August 2005, which consisted of the regulation of open market operations, the prohibition of margin trading transactions in foreign currency against rupiah by commercial banks, the introduction of hedge swap facilities, and another regulation on net open positions. Despite all these efforts, macroeconomic stability was only restored after the government increased domestic gasoline prices by 129% in October 2005. Depreciation pressure was down, but inflationary pressure pushed through until the end of the year. This slide highlights everything that I just mentioned earlier. In contrast to the situation in 2004 to 2005, capital inflow to emerging countries, including Indonesia, increased tremendously after the Fed implemented their QE policies in the first half of 2009. Surprisingly, in observing the composition of gross capital inflow to Indonesia since 2010, most of it went to portfolio investments through government securities and central bank certificates. Only a small portion went into the equities market. Nevertheless, the Indonesian government tightened its monitoring and supervision of net capital inflow in order to maximize the benefits and manage the risks associated with it. Policies deployed by the central bank post-2009 crisis involve a combination of macroeconomic stabilization, monetary policies, and macroprudential policies in an attempt to keep exchange rate movement stable and to limit the movement of short-term capital flow. Indonesia's experience in 2010 showed that macroprudential policies to manage capital flow and domestic liquidity is substantial since it reduces pressure on the central bank to make limitless intervention in the foreign exchange market that will create unnecessary burdens on its own balance sheets. So in June 2010, the central bank issued a policy package to manage massive capital inflows to the country, which included the implementation of the 1-month minimum holding period, or the MHP, of the BI certificate. Bank Indonesia also introduced a 1-month term deposit in rupiah, which will be useful for commercial banks to place their excess of short-term liquidity. At the same time, the central bank reduced the frequency of SBI actions. Furthermore, Bank Indonesia revised commercial banks' net open position into December 2010, which stated the limit of daily net open position for commercial banks was set at a maximum of 30% of its capital. In addition to that, Bank Indonesia also increased its statutory reserve requirement for foreign exchange deposits from 1% of third-party funds to 8%. BI also lengthened interval of auction from weekly to monthly and offered longer BI notes maturity from 1 to 3 and then to 9 months in August 2010. They also increased the rupiah reserve requirement from 5% to 8% in November 2010, as well as linking reserve requirements to loan deposit ratio. According to BI data, the minimum holding period was effective in reducing exchange rate volatility, increasing government securities and government notes purchased by foreign investors, and reducing foreign ownership of SBI. In May 2013, the Federal Reserve issued a statement to end the quantitative easing policy gradually, considering the recovery of the U.S. economy. This raised concerns over a sudden reversal and triggered capital outflow. During 2013, the central bank increased interest rate from 5.75% to 7.5% over the course of 7 months in order to curb both inflationary and depreciation pressure. In November 2014, the BI rate was increased again from 7.5% to 7.75%. They also revised the holding period on BI certificates from 6 months to 1 month. The limit on offshore borrowing by banks was relaxed by expanding a number of transactions that are excluded from the calculations of banks' offshore borrowing. New tradable OMO instruments were introduced in the form of BI certificates and of deposit. BI also lowered the upper ceiling of loan-to-deposit ratio, introduced loan-to-value ratio to property lending, and launched a forex term deposit with various maturity periods, ranging from 1 day to 12 months. Despite all the uncertainties and large capital outflow, however, capital inflow continued to climb up until the last quarter of 2014. Overall, compared to 2013, portfolio investment liabilities doubled in 2014. Private sector liabilities and other investments, which reflect foreign borrowings by Indonesia's private sector, also experienced a large increase throughout 2014. Meanwhile, Indonesia's current account balance experienced persistent deficits. These next 2 slides list out all the policy responses that I listed out before, but comparing each episode side by side. Okay. In the next 3 slides, we'll be looking at the impact of the 3 previous episodes on macroeconomic indicators, namely on real GDP growth, inflation, current account balance, and real effective exchange rate. So in the run-up to the 2004 crisis, the rupiah appreciated in 2003. However, depreciation pressure in 2004 due to capital outflows brought the value down. Nevertheless, depreciation did not help current account balance since its overall surplus dropped from 3.4% in 2003 to 1.2% in 2004 due to much higher import growth than export growth. On average, GDP growth in 2004 was lower than in 2003. Except for the last quarter of 2004, when the new administration was inaugurated. Inflationary pressure was up due to imported inflation during the capital flight period, but was not worrisome throughout 2004, partly due to the central bank's policy switch from accommodative to tightened monetary policy in June 2004. But in the following quarter, 2005 quarter 1, inflation rate rose due to severe droughts in parts of Indonesia. A further increase of international oil prices continued to raise investors' concerns over the government's budget deficits until the government increased domestic oil prices twice in October 2005. Towards the end of 2005, inflation rates soared up due to the increase in domestic oil price to 17.1%. Throughout the 2010 to 2011 capital surge episode, GDP growth was up from 4.63% to 6.22%. Inflation shot up from 2.78% to 6.96%, while foreign reserve rose to 7 months of imports. Due to appreciation during this massive capital inflow, the current account balance suffered a deficit over the following year, 2011 to 2012, that is. More detailed observations showed that sources of GDP growth in 2010 were gross fixed capital formation and net export growth. However, net export growth was much slower than the previous year, where it grew to 12.5% in 2009. This is partly due to appreciation of the rupiah in 2010 from massive capital inflow. Inflationary pressures were up due to disruption on food supplies. Core inflation stayed similar to last year in 2009. Throughout the 2013 capital flight episode, there clearly was depreciation, which would normally improve the current account balance. However, in this case, the current account balance still experienced persistent deficits. This implies that the problems were more structural in nature, particularly in the export-import market. Inflation decreased, as expected, immediately after the episode. However, it increased drastically in Q4 2014 due to the increase in domestic oil price implemented in June. The impact of this rise in domestic oil prices was delayed as Indonesia was still experiencing large amounts of capital outflow due to foreign concerns over the current account deficit. So, it is evident that Indonesia has experienced highly volatile capital flow over the past decade, although from the 3 previously highlighted episodes, the underlying causes have been different. It is therefore important for the monetary authority to be able to identify these causes and address them accordingly. An example of this lies in the 2004 to 2005 capital flight episode caused by foreign concerns over the soundness of Indonesia's economy. During this time, we suffered current account deficits aggravated by rising global oil prices. Indonesia's exported a lot of oil but subsidized domestic fuel prices. Responding to the large capital outflow, the central bank introduced various measures which had a limited impact on in stabilizing the flow. Capital flow only started stabilizing after the government raised fuel prices significantly. From this example, we also learned that although the central bank is in charge of managing capital flow, its success often depends on the support and cooperation of other government institutions and agencies. In this case, setting fuel prices is beyond the purview of the central bank. It is the responsibility of the Ministry of Finance to set fuel prices. It should be stated, however, that more often than not, external factors are the greatest determinants of capital flow volatility, as shown in the more recent cases since the onset of the GFC. In 2010, Indonesia experienced a capital surge, while in 2013, it experienced large capital outflow. It is clear from the foregoing discussion that those events were closely related to the circumstances in the US, particularly with the loosening and the expected future tightening of the US monetary policy. Results from our VAR model, which found that volatility index and global liquidity were the most significantly affect capital flow movement, further supports this notion. As such, we can conclude that there's nothing we can do to prevent capital flow fluctuations. What we can do is manage it. We know that it's only a matter of time before the Fed starts tightening its monetary policy. From experience, this will be followed by a large capital outflow. While there is nothing that Indonesia can do to prevent it, BI has introduced various measures to dampen adverse effects of such an outflow. The measures constitute a mixture of macroeconomic stabilization, monetary, and macroprudential policies. Nevertheless, BI and the government also face some constraints, some of which are structural in nature. The shallowness of the country's financial market implies, among other things, that BI has a limited number of instruments at its disposal to conduct its monetary policy. It also means that currency and maturity mismatches still constitute a problem that the central bank should be aware of. Regardless, Indonesia has yet to implement any capital controls and has mostly stuck to prudential measures. Whether or not we should enforce capital control is an open question, as the effectiveness of capital control itself, especially in emerging countries, has thus far been mixed. As Hendarsia from BI argues, capital control are double-edged sword best safe for emergencies. So, nevertheless, maintaining prudent macroeconomic policies and selective prudential measures is necessary to take full advantage of short-term inflows and to mitigate the risk of capital reversal. The big challenge for Indonesia at present is how to improve the composition of capital inflow to a longer-term productive use so as to support sustainable growth. In particular, Indonesia needs capital inflows aimed to increase investment into productive sectors, which can expand the capacity of the economy. Without increasing the productive capacity, the rapid growth of consumption will always be accompanied by inflationary pressure. In addition, it may be worthwhile for the central bank to try and persuade private investors to reduce gross outflows when the country appears to be facing a looming capital account crisis. This attempt is worth trying given the fact that herd behavior and self-fulfilling prophecies are among the defining characteristics of the global financial markets. Thank you.